In 1933, a single law separated your savings from Wall Street's gambling tables. By 1999, that wall came down. What followed was the largest financial collapse since the Great Depression. Tonight, we uncover the forgotten banking regulations that once held nations together, laws so powerful they prevented crises for half a century, yet so forgotten that when they vanished, few even noticed. This is the story of how we protected our economies, why we stopped, and what it cost us. To understand what we lost, we must first travel back to October 1929. The Roaring Twenties had transformed America into a nation drunk on speculation. Banks weren't just safeguarding deposits, they were using customer money to gamble on stocks, real estate, and wild financial schemes. When the market crashed, it didn't just wipe out investors, it obliterated ordinary families. Your grandmother's savings, your neighbor's life insurance, your father's paycheck all vanished because banks had bet it all and lost. Within 3 years, over 9,000 banks failed. 13 million Americans lost their jobs. The economy contracted by nearly 30%. But here's what history often overlooks. This wasn't just an American catastrophe. Germany's Weimar Republic collapsed into hyperinflation and political chaos. Austria's Creditance-Talt, one of Europe's largest banks, failed spectacularly, triggering a continental banking panic. Britain abandoned the gold standard. The global financial system was in freefall, and with it, democracy itself trembled. On March 4, 1933, Franklin Delano Roosevelt stood before a terrified nation and declared, "The only thing we have to fear is fear itself." But fear had already done its damage. Roosevelt needed more than words. He needed a new financial architecture. Enter the Glass-Steagall Act of 1933, formerly known as the Banking Act of 1933. Senator Carter Glass and Congressman Henry Steagall crafted legislation that would fundamentally reshape American banking. The concept was revolutionary in its simplicity. Separate commercial banking from investment banking. Commercial banks would take deposits and make loans safe, boring, essential. Investment banks would underwrite securities and trade stocks, risky, exciting, separate. Never again would your family's savings subsidize Wall Street's latest gamble. But Glass-Steagall was just the beginning. The Securities Act of 1933 and the Securities Exchange Act of 1934 created transparency requirements and established the Securities and Exchange Commission. For the first time, companies had to disclose real financial information before selling securities. Fraud and manipulation faced serious consequences across the Atlantic. Nations watched and learned. Britain's 1979 Banking Act established formal supervision. Germany maintained its universal banking model, but with strict capital requirements and regulatory oversight. Switzerland, already known for banking secrecy, implemented rigorous capital adequacy standards. France nationalized key banks to ensure stability. Each nation found its own path, but the destination was the same. Never again would banking crises destroy entire economies. The Bretton Woods Agreement of 1944 took this further. As World War II drew to a close, delegates from 44 nations gathered in New Hampshire to create a new international monetary order. They established fixed exchange rates, created the International Monetary Fund and World Bank, and built a system of cooperation that would govern global finance for decades. And here's the remarkable thing. It worked. From 1945 to the early 1970s, the developed world experienced what economists call the golden age of capitalism. Growth was strong, inflation was manageable, and banking crises were virtually non-existent in developed nations. When smaller crises did emerge, regulators had the tools and authority to contain them quickly. The system wasn't perfect. It was rigid, it limited innovation. Investment banks complained about missed opportunities. Commercial banks chafed at restrictions. But it was stable, gloriously, reliably stable. Your deposits were safe, your pension was secure. Banks were boring, and boring was beautiful. But stability breeds complacency, and complacency breeds amnesia. By the 1970s, a new generation of bankers and economists came of age, men and women who had never known financial catastrophe. The Great Depression was history, not memory. To them, regulations weren't protective walls, but restrictive chains, holding back progress and profit. The intellectual groundwork was laid throughout the 1970s and 1980s. Free market. Economists argued that deregulation would increase efficiency and competition. Financial innovation was portrayed as uniformly positive. The invisible hand of the market, they insisted, would regulate itself better than any government bureaucracy. The erosion began gradually in 1980. The Depository Institutions Deregulation and Monetary Control Act started dismantling interest rate controls. The Garn-Saint-Germain Act of 1982 further relaxed regulations on savings and loan institutions. Then came Black Monday, October 19, 1987. The stock market crashed, losing 23% in a single day. But here's what's crucial: the banking system held. Commercial banks remained stable because they weren't entangled in the crisis. Glass-Steagall had done its job. Yet instead of recognizing this success, many pointed to it as proof that the old rules were obsolete. After all, the market recovered quickly. What was the harm in a little more freedom? Throughout the 1990s, the walls grew shorter. Bank holding companies found loopholes and exploited them. Citicorp merged with Travelers Group in 1998, openly defying Glass-Steagall's intent. Regulators looked the other way, granting temporary exemptions that became permanent in practice. And then, on November 12, 1999, President Bill Clinton signed the Gramm-Leach-Bliley Act. With a stroke of his pen, Glass-Steagall was effectively dead. Commercial and investment banking could once again merge. The wall that had protected Americans for 66 years crumbled into dust. Clinton celebrated it as modernization. "This is a good day for the United States," he declared. The banking industry threw champagne parties. The New York Times editorial board praised the move. Few voices of dissent were heard, and those that spoke were dismissed as dinosaurs clinging to outdated thinking. What no one seemed to ask was, if the old system was so terrible, why hadn't we seen a major banking crisis in over half a century? Less than a decade later, the world had its answer. With Glass-Steagall gone, commercial banks rushed into investment banking. They created complex derivatives and mortgage-backed securities. They took enormous risks with depositor money. The boring banks of the 1950s became the casino banks of the 2000s. Shadow banking emerged, a parallel financial system operating beyond regulatory reach. Hedge funds, private equity firms, and investment vehicles created leverage upon leverage, risk upon risk. The system became so interconnected that no regulator could map it, let alone control it. In 2007, the subprime mortgage market collapsed. By September 2008, Lehman Brothers failed. Bear Stearns vanished. Merrill Lynch was sold in a desperate weekend. AIG teetered on the brink. Washington Mutual became the largest bank failure in American history. But here's the critical difference from 1929. This time, banks weren't just too big to fail, they were too interconnected to fail. Commercial banking, investment banking, insurance, and shadow banking had become so entangled that the failure of any major institution threatened the entire global system. Governments had no choice but to intervene with trillions in bailouts and guarantees. The cost to taxpayers was staggering. The cost to ordinary people was devastating. 8 million Americans lost their jobs. 6 million lost their homes. Retirement accounts evaporated. Small businesses collapsed. And the crisis wasn't contained to America. Iceland's banking system completely collapsed. Greece, Ireland, Spain, and Portugal faced sovereign debt crises. The European Union teetered on the edge of dissolution. Even China, with its controlled economy, felt the shock waves. The irony was almost too painful to bear. We had dismantled the protections built after the Great Depression and recreated the exact conditions that caused it. In response to 2008, governments enacted new regulations: the Dodd-Frank Act in America, Basel III internationally. The Volcker Rule attempted to recreate some of Glass-Steagall's separation, though in weaker form. But here's what makes our story particularly poignant. These new rules were immediately attacked as onerous and restrictive. By 2018, significant portions of Dodd-Frank had been rolled back. The Volcker Rule was weakened. The cycle of forgetting had already begun again. So what can we learn from the forgotten banking laws that once held nations together? First, that stability has value. enormous value that's only recognized in its absence. The boring, stable banking system of the 1950s and 60s enabled unprecedented economic growth and broadly shared prosperity. Innovation happened, but within guardrails that protected the system. Second, that financial memory is dangerously short. The generation that experienced the Great Depression never forgot its lessons. They built a system designed to prevent repetition, but their grandchildren, having never known catastrophe, dismissed those lessons as outdated. Third, that complexity serves those who create it. Modern financial instruments became so complex that even experts struggled to understand them. This wasn't accidental complexity obscures risk and delays accountability. Today we stand at another crossroads. Cryptocurrency and decentralized finance promise to revolutionize banking once again, operating beyond traditional regulatory frameworks. Some see liberation, others see the same pattern, repeating innovation without guardrails, profit without accountability, risk without responsibility. The laws that held nations together weren't forgotten because they failed. They were forgotten because they succeeded so well that their necessity became invisible. We dismantled them not because we found something better, but because we forgot why they were built. Glass-Steagall and its companion regulations represented a simple wisdom: that some activities are too important to gamble with, that speculation and security must be separated, that markets require rules to function sustainably. These weren't perfect laws. They didn't solve every problem. But for over half a century, they provided something precious and rare: financial stability that allowed families to plan, businesses to invest, and nations to grow. The question we face now isn't whether we can return to 1933's exact solutions. We can't. Financial systems evolve, and regulations must evolve with them. The question is whether we can learn the underlying lesson, that the freedom to profit must be balanced by the responsibility to protect, and that some walls exist not to restrict us, but to save us from ourselves. The forgotten banking laws that once held nations together offer us a mirror. In their rise, we see wisdom born from catastrophe. In their fall, we see amnesia born from success. And in their absence, we learned once more why they mattered. The only question is, will we remember this time?